Secretary Lutnick, there's been a huge focus, and you've been talking about how U.S. tech has definitely been the bastion of the economic growth over the past couple of years. Has the Trump administration decided whether or not to allow Nvidia to sell the H200 chips into China? That's been a discussion and something that increasingly people are speculating about.
Well, I've seen that speculation. That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from Nvidia, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
In an interview with Bloomberg News on Monday, Commerce Secretary Howard Lutnick stated that U.S. President Donald Trump is considering allowing Nvidia to sell cutting-edge AI chips to China. Lutnick was reported in the report as adding that the president is seeking advice from lots of different advisors before determining whether to export. According to the story, Trump is debating whether to approve the sale of Nvidia's H200 AI chips to China. This follows media reports on Friday that described preliminary talks between U.S. authorities about selling the H200 chips to China. The H200 chips, which were introduced 2 years ago, can handle data faster than their predecessors, the H100, because they contain additional high-bandwidth memory. Following a trade and technology truce mediated by Trump and his Chinese counterpart Xi Jinping in Busan last month, the possible relaxation of export restrictions represents a more lenient approach toward China. According to an Nvidia representative, the company is unable to offer a competitive data center GPU in China due to current rules, which gives foreign competitors a substantial advantage in that sizable market. A request for comment from Reuters was not immediately answered by the White House. Due to export limitations that were initially put in place in 2022 to ensure that Beijing's military would not profit from American technology, China has continued to be a burden for Nvidia. As a result, the business has decided to explore fresh growth prospects in the Middle East. Last week, the Commerce Department declared that it had authorized exports of up to 70,000 Nvidia Blackwell chips, the company's next-generation AI chip, to Humane in Saudi Arabia and G42 in the United Arab Emirates. Despite rumors of a potential agreement for a reduced version, Nvidia CEO Jensen Huang had stated earlier this month that there were no active discussions about supplying Blackwell chips to China. In its Q3 report, Nvidia achieved faster revenue growth and above projections. Jensen Huang brushed off worries about an artificial intelligence bubble. To gauge the strength of the AI boom, investors might be better suited concentrating on businesses like OpenAI and Anthropic. Nvidia appears to be disproving the adage that sequels are never as excellent as the original. 3 years after the artificial intelligence AI boom began with the release of OpenAI's ChatGPT, Nvidia continues to produce record-breaking results and consistently surpasses Wall Street projections. The star of AI chips announced $57 billion in revenue for the quarter, a 62% increase over the same period last year. That was significantly more than the forecast at $55.1 billion, and actually indicated an increase from the second quarter, when sales growth had slowed to 56%. Interestingly, China did not return substantial revenue during that acceleration. The main driver of the AI surge, data center revenue, grew even more rapidly, rising 66% to $51.2 billion. At a time when tech companies, particularly those most exposed to AI, such as highly leveraged neo-cloud operators like CoreWeave and Nebius, have been declining, the announcement helped allay concerns about an AI bubble. Before the release, Nvidia had dropped 12% from its most recent high, but it gained 6% in response to the news, gaining $300 billion in market value and regaining its approach to a $5 trillion market cap. Jensen Huang, CEO of Nvidia, didn't hold back when discussing the idea of an AI bubble. He actually addressed such worries at the outset of his results call remarks, stating, "There has been a lot of chatter about an AI bubble. From where we are, we see something quite different." Huang continued by explaining the significant expenditure on non-AI software and making the case that accelerated computing has reached a tipping point, which also applies to AI. He claimed he observes a movement from central processing units, CPUs, to NVIDIA graphics processing units, GPUs. According to NVIDIA's guidance, its rapid growth will continue into the fourth quarter. The company is aiming for revenue of about $65 billion, which is significantly higher than the $62 billion that was anticipated and represents 65% growth from the same quarter last year. This means that NVIDIA's revenue growth will pick up speed again in the fourth quarter, reaching 65%. Zooming out is necessary for investors. It makes sense to make NVIDIA the face of the AI revolution. After all, since ChatGPT was introduced, NVIDIA's stock has surged. Thanks to AI and its continued dominance of the data center GPU and AI computing markets, it is now the most valuable firm in the world, valued at around $5 billion. Investors who are watching NVIDIA for signs of an AI bubble, however, should also look elsewhere. Though NVIDIA is providing the tracks for the AI boom, which only matters if people want to ride the trains, the company's contribution to the AI revolution is crucial. In technology, it refers to the hardware that NVIDIA offers for AI software. The easiest approach to find out is to look at the AI startups that are setting the standard, such as OpenAI and Anthropic. CFO Colette Kress highlighted the rapid expansion at these firms as well as others, pointing to a positive feedback loop that is growing acceptance and profits. Because companies are privately held, OpenAI and Anthropic are more difficult to follow, but their statistics support their statements and should ease bubble worries. Although OpenAI is valued at $500 billion, it anticipates more than tripling its revenue this year to $13 billion, or a $20 billion run rate. Given its rapid growth, OpenAI appears to be fairly valued when compared to software, which is commonly valued at 25 or 30 times revenues, or even higher. Sam Altman, the CEO, even predicted that the business might reach $100 billion by 2027. Similar circumstances apply to Anthropic, which is expected to generate $9 billion in run rate revenue by the end of 2026 and aims for $20 billion to $26 billion, making its $350 billion value appear reasonable as well. The top 3 software companies are now all AI software companies, including Palantir, which has a $400 billion market capitalization. As Huang predicted, we'll probably see a greater movement in the tech sector's software value toward AI. Concerns about an AI bubble seem unfounded as long as businesses like OpenAI and Anthropic are doubling or tripling their earnings. NVIDIA's executives clarified that a positive virtuous cycle and a tipping point are imminent. Since AI adoption is accelerating at both the hardware and software levels, investors shouldn't confuse the issues facing the overall economy for flaws in the AI narrative. According to NVIDIA's most recent financial results, which were made public last week, artificial intelligence, AI, is still in the early phases of a huge, long-term investment curve. Over the next 20 years, investors who hold shares of competitively positioned AI leaders with outstanding growth potential could become generational wealthy. For a stock that is now priced at less than 25 times the projected earnings for next year, NVIDIA continues to report impressive growth. Sales to data centers accounted for 90% of the gain in revenue, which rose 62% annually. Over the past 3 years, NVIDIA has routinely experienced this kind of growth, which has caused the stock to surge. By 2030, it is anticipated that spending on AI infrastructure would amount to trillions of dollars. there is competition from businesses that provide more reasonably priced custom AI processors. However, Nvidia's ability to accelerate the release of new chip generations is a key factor in why it will continue to be the data center's chosen chip supplier. Nvidia will continue to be at the forefront of chip technology because to this quicker innovation cycle. Currently, analysts predict that over the next several years, profits per share will increase at an annualized rate of 36%. The stock is trading at barely 24 times the consensus profit projection for next year, and it has risen 38% so far this year. Purchasing and holding this AI stock for a long time makes perfect sense. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
The team at Morgan Stanley releasing their outlook for 2026, writing, "We raise our S&P 500 price target to 7,800, driven by strong earnings growth. We believe that we're in the midst of a new bull market and earnings cycle, especially for many of the lagging areas." Mike Wilson of Morgan Stanley joins now. Wonderful to see you, Mike.
Thanks, Lisa.
So let's start on the optimism. You have been optimistic for quite a while, talking about the rotation into the adopters, not just the AI tech behemoths. Why are you getting even more optimistic as the year goes on?
Well, I would say it's just a changing, it's an evolving narrative we've had, which is that we think that, the policy is still misunderstood, right? That they essentially came in this year, did the growth negative stuff first, and now we're looking at the growth positive stuff. I'm not worried about the economy. What I am a little bit worried about is that the Fed is kind of dragging its feet. So I would agree with Neil's comment, like the Fed needs to cut, but not to save the economy, but to see the full rotation into these lagging parts of the market, the interest rate sensitive parts of the market, which is really our story for 2028 or 2026. We think that 7,800 is dependent on the earnings cycle broadening out.
So there's a lot to unpack there. I want to start with you agreeing with Neil, because Neil had a pretty negative assessment of the overall economy, saying he suspects the train's already left the station with respect to the pain from the Fed keeping rates where they are for as long as they have, and that we could be looking at a recession. You seem to disagree on that. So where's the nuance here? What's the difference between preventing recession and really allowing the rotation into some of these other names?
Yeah, I think our view has been differentiated, that we think we have had a recession. We went through a rolling recession in the private economy. So I would agree with Neil that the economy is weak, but it's rebalancing now towards the private economy. Many parts of the economy have been suffering: housing, all the interest rates, durable goods, consumer goods, which have been under pressure, commodity sectors, transportation. There's been no volume going through the economy, no velocity in the real economy. And the way that the administration is changing the policy, in addition to the Fed now cutting hopefully next year, you'll see the private economy now doing much better, the government no longer crowding out these areas that have been under pressure. But we do need to get that trend, that the Fed needs to do more. The Fed needs to cut rates, and they need to probably provide some balance sheet.
I'd say one of the things that Neil talked about was his fear that even if they cut in December, they're not going to lay out a path for continuous cuts. And Fed Governor Waller seemingly enforcing that, speaking on Fox moments ago, saying you might see more of a meeting-by-meeting approach once you get to January. If you do get that posturing from the Fed that maybe they cut in December, but it's a meeting-by-meeting approach, they're not necessarily going to cut in every single one, is that enough to allow for that rotation, or do you need a clear path of cuts to get it?
No, we need the latter. And I think we're going to get there one of two ways. Either the data, the labor data is going to basically support our view, or my view, that we had a rate of change trough in the labor markets in April. Okay, and so that data then will allow the Fed to cut more, or signal they're going to cut more. The second one is that we get more financial stress. Okay, that's what's been going on. We think the market, we wrote about this back in September, early October. We thought the market was going to have a 10 to 15% correction because the liquidity wasn't there, that the balance sheet was tightening. And we think there's evidence that correction is well advanced. Okay, all the momentum stocks, crypto obviously is the topic of the day, down 30% for Bitcoin. These things are telling you that the market is worried about this liquidity. So as usual, the markets will dictate, the Fed's timing. So if the market really wants, and look, markets are like children, right? They'll have a little temper tantrum, and then the Fed will respond to that. So is this like a mini 2018 in that regard, right? You have that, you kind of go into end of the year, and then there's stress in some of these financial metrics that the Fed cares about, and then they provide more balance sheets. So we think there's a sort of this tug of war going back and forth, but ultimately it resolves in a more dovish policy path.
On the point of crypto, a lot was made, I mean, even from Bill Ackman basically saying things that he thought weren't correlated all of a sudden were, that Fannie and Freddie were selling off because the people who were buying crypto were the same people in those names. Did last week and the week before's episode, given how much crypto falls, show some vulnerability within the market structure, within who owns these stocks and how fragile and weak some of those hands are?
I don't think it's showing anything new. I think this has been there whole time, right? I mean, I don't, people waking up to the idea that liquidity is important for the market. I mean, obviously, I don't know what they're doing. I mean, like, that's kind of crazy. I mean, of course, liquidity matters. I mean, liquidity is, and especially the last 10 years or so. I think that the hard part about liquidity is it's sort of this sort of nebulous thing. It's hard to measure. And I've spent a lot, like the last 2 or 3 years, trying to develop a better skill set around that, and I think we've got a better handle. But I would say it still is one of these things that's sort of the invisible hand. And so what you have to do is you have to look at the market to tell you when liquidity is tight or not.
So you kept mentioning the balance sheet. Are you saying QE is going to start again?
Well, they may not call it QE, but yeah, the balance sheet needs to expand, not only to support financial markets, but to support the better growth that I think is coming next year, right? So if CapEx really picks up for the first time in 10 years, okay, let's be honest, we haven't seen much capital spending, but the big beautiful bill is incenting that. That's a usage of capital that needs to be supplied by somebody. So the balance sheet needs to grow just to help the economy and the markets. And so we can call it QE, call it not QE, but generally they need to expand that.
How much is the 7,800 target predicated on the idea of the Fed cutting rates and using its balance sheet to help support liquidity?
It's very important. I mean, I would say if we don't get at least one of those items surprising the markets, meaning more than 3 cuts, or we get more balance sheet expansion, call it QE, call it something else, okay, yield curve control, whatever you want to call it. Okay, if we don't get some combination of that, then we're not going to reach our target. So I'm assuming that we get there either through the labor data or through some financial stress.
So it has been so far that the AI trade has maintained any kind of equity valuation, despite the fact that people are getting increasingly worried about an economy that you think already has gone through recession. I just wonder, do you think that ship sailed in terms of AI leadership propping things up? Do you think that if we don't get the real economy reaccelerating, you cannot get the multiples that we currently have been seeing on the big tech names?
Yeah, I think it's one and the same. I mean, obviously the investment in AI is on the premise that it will lead to higher productivity, adoption, and all of that works. I mean, that's the way technology investment works. So you're not going to, these stocks are not going to work. The leaders aren't going to work if the foundation itself isn't being supported by the technology investment. We assume that is going to happen in 2026. That is part of our thesis. Okay, but it's not without risk. So our job is to lay out our narrative, which we have conviction in, but then to highlight these risks in the short term or in the medium term that could throw that narrative off.
Eddie Ardeni also joined us earlier, just saying that some of the air is being taken out of the AI bubble. And to him, that meant that the melt up that we've been seeing is going to be harder to come by. Has something changed, at least with that blind willingness to continue to buy AI-related stocks, regardless of how much they're spending and what the return on that spend is?
Well, I mean, this is a natural evolution of any capital spending cycle. There's always going to be a challenge on the return you're going to get. And this is, we've seen this multiple times. We saw it a year ago. We've talked about this, multiple times. In July of 2024, that was the peak in sort of an AI CapEx deceleration. So this is an ebb and flow. What I like to look at is the AI spenders. How are those stocks reacting? Is the market enforcing discipline on the AI spenders, which then trickles down into the CapEx beneficiaries? But we think this is going to happen. I mean, the money's been raised now, so like the debt markets are now involved, and so that money's not going to sit on these balance sheets. It's going to be spent. The question is, what's the payoff look like, and what's the timing of that payoff? We think we'll see some of that in 2026, 2027. And so now it's just this transition. You're kind of trading back and forth. So I want to make it clear, we think there's a broadening out. That doesn't mean that all the AI stuff gets killed and everything else does really, really well. It can work in harmony. In fact, it needs to work in harmony to some degree.
If you do get a scenario, though, where, let's say, Meta, that seems to be one of the poster children for not getting that return, doesn't get it as much, and they need to pull back on their spending, but everybody else is still spending. Do you only need one pillar to fall to really hurt this trade, or can just any sort of spending happening within this trade, regardless of who the winner is, continue to lift all the boats?
Well, look what's been going on, right? So we've seen a massive bifurcation or dispersion in the performance of not only the hyperscalers but names within that. To me, that's healthy. That's like, not everybody's going to win. Okay? There's no trophies here. I mean, you have to actually win the game. but all of these companies are competing for the trophy. So in that competition, I think we continue to see this velocity of spend, and then we're going to see the most exciting part about this AI spend to me is we don't even know yet, okay, these new businesses that are going to be created, these new industries that are going to be created, the efficiencies we're going to get in areas like healthcare or education or manufacturing, that's on the come. That's where the real wealth creation is going to be coming from.